markets holding above that 24,000 mark, but it's down almost 700 points. And it's not just the equities market. You know, we're seeing a lot of other assets also seeing a bit of a sell-off. As our ticker team is telling us, the crypto universe has also seen a big sharp sell-off. Nearly $70 billion eroded in wealth, and it's turned negative for the year for major cryptocurrencies too. So the only thing which rises when the market falls is the correlation between all assets. All of them are, seeing a sharp sell-off itself. Typically, these sell-offs are, in hindsight, used as or said to be big buying opportunities. So are they buying opportunities now or not? Deepak Jasani, the head research of HDFC Securities, joins in now. Deepak, when the market wasn't falling, a lot of people were saying valuations are frothy. We will wait for corrections to go ahead and buy. Now we're seeing a big cut in a lot of these names which have seen a big rally, be it these defense names, rail names, a couple of these infra names, and a lot of IT names where people would have missed the recent rally that took place as well. What are you suggesting to your clients? Do you see further downsides from here, stay on the sidelines, or maybe start dipping into this big decline that we've seen in our markets?
Yeah, good afternoon, and thanks for having me. Mangalam, currently we are seeing a combination of economic troubles and geopolitical issues, which has not happened for some time now in the markets. A lot, as you must be aware, markets are driven by sentiments, and now how far the sentiments are punctured due to this and how much time will it take for this to get repaired, we'll have to watch out. We'll have to closely monitor that. Having said that, I think the sell-off temporarily seems to have come to some sort of a bottom, near-term bottom. Nikkei at about 30,500 and US dollar, USD JPY level of about 140.5. These two levels are supports. So we think in the near term, we could see a small bounce from here, but with traders could take advantage of that bounce. Investors, on the other hand, will have to see as to how far the bounce goes from here and how fast is the bounce. So in case the bounce is very labored, then probably it would mean we will form a lower top. So in that sense, I think investors should lighten up even now and in the forthcoming bounce. Buying the dip has always worked in the past. We have seen from June 22 or from March 23, markets haven't seen a very big correction, and every dips have been taken advantage of. So this time around, I think it would be wiser to hold back a little before jumping in the buy on dips kind of a strategy.
Okay, so just to get it clear, Deepak, today if somebody wants to deploy money into the markets, you tell them to hold off and probably assess what's going to take place with the global markets. Right.
Because the geopolitical developments are also not yet over for the time being. So every bounce may be sort of taken advantage of from now onwards. So one will have to let the market settle down. Unless the bounce is very sharp, I think they will get sold into.
Okay.
What sectors would you look at putting money in right now? Because, the ones which are doing well are the ones that typically do well during flights to safety, which is the FMCG space, which is mildly higher right now after a spate of underperformance in the past as well. We've seen, some of the pharmaceutical names also see some buying. Would you buy the ones which are doing well right now because they haven't done well in the past? Or would you look at buying, themes which are seeing some profit taking like defense, rail, infra, all of them, which have structural levers but are extremely expensive?
So we would stick to the traditional defensive for the time being, the FMCGs and the pharma. I think IT, there may be some more downside in case the slowdown gets accentuated globally.
Okay. Well, I just want to extend that point, Deepak, because one of the queries that we get from a lot of retail investors is what they should do with a lot of these PSU or PSE stocks that they have invested in and which they're sitting on very good gains with. For example, the Nifty PSE index itself, as we all know, has outperformed. It's up 41% this year itself. But is it prudent to probably just take some money off the table now? for somebody who's probably sitting on a good amount of profits, one? And two, would you probably look to re-enter these stocks or enter these stocks at these levels?
Yeah, so as I said earlier, I think it may be a good idea to sell even now and also in bounces, except for in case you are forced to remain invested in equities. So in that case, I think you can shift gradually to the defensives, but otherwise, the sectors or stocks which have seen heightened interest from the retailers and HNIs over the last few quarters, I think will continue to come under pressure. And it may be a good idea to take profits off and sit on cash for some time.
Sit on cash for some time. How much cash do you think one should sit on, say, because mutual funds are sitting on closer to 7 to 8%, at sometimes even 9%. Some of the PMSs are sitting on 20, 25%, etc. What proportion of cash do you think should be good? And should one also look at gold as an asset class right now, given the sort of uncertainty that we're facing globally, despite the rally that we've seen in gold?
So gold allocation, we have always been advocating 5 to 10% of your financial assets should go into gold. And that stays even now, because in an uncertain world, I think gold can at least save your capital, if not give you appreciation. Now, as far as cash levels are concerned, I think unless you are forced by regulations or by compulsions to beat the benchmark, you have the flexibility to go even 40-50% into cash. This is basically for retailers and HNIs. Mutual funds and PMSs have the other two compulsions, so they may not be able to raise capital to that an extent.
Right, just a correction, Ekta. You know, we were seeing crypto has lost $70 billion in value. It's actually $270 billion. Our ticker team just alerts us, $270 billion in value lost in alternate assets as well.
Yes, absolutely. And that's exactly why gold has become this topic of discussion as well. But Deepak, you know, just wanted your thoughts in terms of the entire IT space now. How would you approach it, considering that there are these gyrations of, you know, negativity which is coming out from big tech? In that context, how would you approach a couple of these IT firms?
So, in IT, I think the visibility of large contracts or TCVs, as it were, may still be lacking for the next 1 or 2 quarters. So, in that sense, they may optically look cheap compared to the past valuations, but their growth rates have also come down. So I think IT stocks are typically they are trading plays. So in extreme sell-off, you get into them, ride the 10 to 15% up move, and get out unless there is a sustainable improvement in the visibility of order flows.
Final question then, what about valuations? I mean, at 25,000, Nifty was closer to 22 times one-year forward earnings. And now we have nearly 86% of the Nifty weight having reported earnings. So far, it's been a little bit of a mix because we saw earnings downgrades of nearly 1.2% of the Nifty so far for this year and almost 1% for the next year as well. On a valuation check, what have you made of these earnings that have come so far, and what looks good post that and what doesn't?
So as far as the valuations are concerned, I think there are key issues to be monitored. One is the final outcome of the monsoon, its spread and intensity once it finishes. We have seen pockets of excessive monsoon and shortage of monsoon in different areas of the country. So ultimately, by the time end of September, how does the monsoon sort of exit? That will have to be monitored very closely. Q1 numbers, the balanced numbers, I think we will have to see. As you mentioned, it has been a mixed bag. There is struggle on the top line and also margins for quite a few companies. Asset quality seems to have come under pressure after 3 or 4 quarters. So those are the worrying signals. There is a US presidential election in November, and there are state elections in October in India. So those things will have to be monitored. Now, valuation-wise, I think we will have to, in case the sentiment remains shaken or poor, despite good earnings expectations, the valuation can slide down, and analysts will at that point of time rush to downward project the estimates.
Right.
So, in that sense, I think valuations will become attractive only when we are closer to 17, 18, or maybe 18 and a half times earnings.
Okay. All right, Deepak, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the view coming in terms of the markets. Just want to point out that a lot of the stocks, say, for example, the M&Ms, which have already given returns of around 54%, ONGC, which is up 51% this year, BPCL also, which is up around 50-odd%. All of them are down anywhere between 2 to 6-odd%. 6-odd% for ONGC at this point. It's the top loser on the Nifty. So sharp cuts coming through there. We'll take a break, but we'll continue with our coverage on the markets. We'll be talking technicals. Manish Hathiramani of Deen Dayal Investments will join in with some trading calls. Stay tuned.